Hi, and welcome to Kepler's last webinar of the year. We're going to get going, having a look at what things kind of OPEC Plus should be looking at as we move through the next few months in terms of can they further open up their supply. Just a couple of things whilst we get going. Your camera and microphone are turned off by default and your participation is anonymous. We will be sending out the presentation to you, so you will be getting all of the slides. Please do ask questions. They are anonymous to the other attendees of the webinar. Only ourselves at Kepler will be able to see them, basically, and we'll have a session at the end of the presentation to run through it. A quick introduction to Kepler for those who don't know us so well. We've been running since 2014, where we've been pioneering data intelligence in the commodity markets. Since then, we've been adopted by all of the various different market participants across the commodities world. We're used by over 5,500 professionals worldwide, and as well as what you see here in terms of the research side of things, all of our information, all of the data is available via our proprietary web app, mobile application. Data is available kind of directly via the add-ins and APIs and an SDK as well. So the presentation today is going to be given by the members of the research team. It's going to be myself and Omayun, and then other members of the team are available to answer questions as well. So we'll head straight into it, and Omayun is going to get the ball rolling as we look at, as I say, what light is appearing at the end of the COVID tunnel of what's been a particularly fraught year, and what should OPEC Plus be looking at? What signals should they be looking at for further loosening of their supply cuts? As I say, we're going to start off with Omayun and the crude supply.
Thanks very much, Alex, for the introduction. It's an early morning for you. So we're going to look at supply first, and especially the few countries and sectors where OPEC Plus needs to keep its eye on, basically, whether it's external competitors or internal. So first, if we focus on non-OPEC, so oil production was actually supposed to grow by 2.3 million barrels per day in 2020, namely from a set of a few countries such as the US, Brazil, Norway, Australia, and Guyana. Out of these 2.3 million barrels per day, basically half of it was supposed to come from US tight oil production. The other half was supposed to come from major offshore projects in the other countries that I just mentioned. So obviously, these places didn't really live to expectations. With production from shale that we're going to see has actually decreased, and only a third of that growth basically was achieved in other countries. So if we look at Brazil first, production increased by about a third of the initial target, which was of 450,000 barrels per day. So production increased by about 140,000 barrels per day. Obviously, the fact that the country didn't reach expectations was driven by COVID-19 issues. So due to lower oil prices, the state oil company Petrobras had cut its 5-year investment plan by about 27% to 55 billion. And it said that it will focus only on its best assets. And lower oil prices also lowered the ramp-up of production from platforms in the Tupi field, so the previous Lula field, and the Atapu oil field as well, which had been the main driver of growth in the past. However, by September 2020, Brazil had become the third largest supplier of crude, of waterborne crude oil to China. Now looking at Norway, Norway also grew, but like Brazil, didn't grow by as much as expected. So production growth reached about 250,000 barrels per day compared to a target of 550. barrels per day, and that's despite an upgrade on the Johan Sverdrup field recently by Equinor. So Johan Sverdrup performed quite well despite some operational slowdowns. Last month, the operator Equinor announced that it will raise production capacity by 30,000 barrels per day to 500 KBD by the end of 2020. And it also plans other increases next year, especially using via the use of water injection and the increase in water injection in the field. The second development phase of Johan Sverdrup that is due to be completed by the end of 2022, and that is supposed to boost production by another 220,000 barrels per day. So in total, production from the field should reach 720,000 barrels per day by the end of 2020. But despite Johan Sverdrup performing relatively quite well, production from other places in Norway has actually decreased. Now, the interesting thing is that Johan Sverdrup, a bit like Brazil, but like where production is increasing in Brazil, the grade is mainly being exported to China. So about half of Johan Sverdrup oil reaches China. Now, on another scale, Guyana, much smaller place, but Guyana actually delivered production growth of about 20,000 barrels per day, higher than expected. Namely thanks to, despite operational issues that the operator ExxonMobil had to face, they managed to commission water injection equipment and to bring natural gas injection fully online as well, and that has allowed the Liza field to perform better, especially towards the end of the year. So at the end of November, these countries are actually on track to reach their targets, not in 2020, but in 2021. But in total, Brazilian exports are still lower by 300,000 barrels per day compared to a year ago. So 1.2 million barrels per day compared to 1.5 million barrels per day last year. Now, moving to the next slide, shale massively under-delivered U.S. shale. So on the shale side, production has decreased by about 200,000 barrels per day on average this year as a result of lower oil prices, and that's while expectations for the year were targeting a growth of 1.2 million barrels per day. So that's almost a 1.5 million barrels per day loss compared to what was supposed to happen this year. Now, on the export side, and that's the graph that you see here, we see a 2-month lag when it comes to exports. So you can see that some grades in shale are actually up. For example, Midland grade is actually up 400,000 barrels per day. That has been the most resilient play. However, other plays such as North Dakota has been the most hit due to a larger price differential with WTI. Now, the decrease on the exports side has been visible from June, in total looking at U.S. shale oil, and it didn't really bottom out since then, even though December exports for now, it looks like they should be higher than November, indicating that production could be on the up again. In general, we can say that efficiency and deflation have helped oil producers in the area. Meaning that capex reductions have not only been used to minimize risks, but also because basically you don't need to do the same amount of work for the same amount of output. So in terms of the current cash break even, we see it currently below $40 per barrel. And all in all, we expect an acceleration of U.S. shale production if WTI reaches $50 per barrel and stays above 50. However, the potential remains limited in 2021, with the services industry being hit quite hard by bankruptcies. And also the Biden election could limit some potential in North Dakota, where there are a lot of federal lands. Now, all in all, U.S. title and major offshore projects elsewhere in non-OPEC could push 2021 production by about 1 million barrels per day higher compared to 2020, mainly driven by the U.S. and Brazil. But there's a condition for this, is that oil prices need to stay above $50 per barrel. Now, moving on to OPEC and OPEC Plus. Obviously, OPEC Plus played a major role in propping oil prices for the major part of the year. Now, the graph that you see here only shows you cumulative cuts in OPEC net exports since the reference month of October 2018. So here we're not showing OPEC Plus, we're only looking at OPEC. However, if we look at OPEC Plus, compliance has remained quite strong so far this year since the deal was reached back in April. In November, we estimate that the group's seaborne oil exports were down 7.6 million barrels per day compared to April. That excludes exempt countries, Iran, Venezuela, and Libya, and also Mexico. And that is just slightly less, the 7.6, just slightly less than the 7.7 million barrels production cuts that the group is targeting. However, I mean, compared to the reference month of October 2018, exports are down by a lesser extent, but the difference could be explained by lower domestic refinery runs in these countries, and also by onshore trade, and namely the Russia to China oil pipeline. Now, what we've been seeing over the course of the past few months is that supply has bottomed out, as you can see on the chart, for OPEC, and has been progressively coming back since June. Now, after providing the biggest effort back in the months of May, June, and July, we're seeing countries like Saudi Arabia and the UAE and also Russia, but even though we're not seeing Russia on this chart, these countries have been bringing more supply while still imposing lots of pressure on the countries such as Iraq and Nigeria to cut. And we've actually seen countries like Iraq and Nigeria make stronger efforts to cut production and exports in the past few months. Now, despite this continuous increasing supply since the month of May, we've seen OPEC Plus lose market share quite significantly since 2018. So just looking again at waterborne oil trade, the market share of OPEC Plus, if we exclude the exempt countries, the market share of OPEC Plus shrank from 67% back in Q4 2018 to 62% now. Now, this is an issue as the market share loss has been bigger compared to non-OPEC. So if we look just since the month of April, basically since the deal was reached, OPEC Plus lost the market share of the market supply of OPEC Plus was down 25% since April. And if we look at the previous countries that we looked at, non-OPEC, this was down only 14%. Now, lastly, on this slide, the decision that OPEC Plus took at the beginning of the month, we believe it's quite wise because, and we'll see this later, that there was probably not enough room, especially in looking at inventories globally, to allow for another 2 million barrels per day in production to come back to the market. So the decision to bring in additional supply on a progressive basis, 500 KBD each month in the first 3 months of the year, is quite wise, but we think it's also prone to more volatility because at the end of each month we'll have one OPEC Plus meeting, and there could be more sticky points that arise between now and then, preventing them to reach a new consensus. Additional supply in 2021 from OPEC Plus, we think, will reach between 500 KBD and 2 million barrels per day, excluding exempt countries. Now, exempt countries probably are the elephant in the room right now. So obviously, especially as Joe Biden was elected president and as he's preparing to enter the White House. But basically, so what the chart here is showing you is the amount of oil exported out of these places. So we're looking at Iran, Libya, and Venezuela. So Iran and Venezuela obviously hit hard by U.S. sanctions. Libya, it's not a story, it's a civil war, but also was being hit for most of 2020. All three countries have made it clear that they wouldn't abide by any production cuts in 2021, and that basically they would produce and export whatever the maximum amount of oil that they can export to make up for previous losses. Now, this is, we think, a potential threat for OPEC Plus and other non-OPEC countries. So looking at Libya, for example, the comeback was quite astonishing. It was astonishingly quick. So if we look at the month of November, exports already reached above 1 million barrels per day, and they were only down 8,000 barrels per day compared to the 2019 average. Even though on the longer term, technically speaking, and looking at reservoir management, we believe it could be hard for Libya to maintain that level of exports, but it's come back very, very quick. Other countries, so Venezuela, I would think, could face technical hurdles, especially with the fact that a lot of its production capacity is basically down. But we believe that it could eventually bring on an additional 500,000 barrels per day of oil, especially if it's able to import naphtha and condensate to trigger upgraders activity. So that could boost production. However, the situation is maybe a bit more positive on Iran, given the fact that Biden is more likely to make Iran a higher priority for its foreign policy. Looking at Iran, technically speaking, it would be able to bring back another 2 to 2.5 million barrels per day of crude and condensate to the market over the course of 6 to 12 months, depending on how fast sanctions are eased. The thing is that we assume that some countries may not wait for sanctions to be lifted or for waivers to be granted, and especially China. We believe that China could increase its imports, its intakes of Iranian oil very quickly, basically as soon as Trump is out of office, meaning that Iran's return to the market could be a bit more gradual, with up to 400 KBD returning fairly quickly, and the rest of capacity depending on sanctions being lifted. And the Iranian oil minister yesterday made it clear that basically Iran would produce as much as possible, and that OPEC Plus will not have a say in these matters. So looking again back at these three countries, we're talking of about 2.5 million barrels per day to 3 million barrels per day of additional oil that could hit markets in 2021. So looking at the total situation with non-OPEC, OPEC Plus, and exempt countries part of OPEC Plus, that's a lot of oil. That's more than 5 million barrels, more than 6 million barrels per day of oil that could hit back markets. And basically the question that goes from here is, will there be enough demand to absorb this potential additional oil in the market?
Brilliant. Thanks, Amin. Yes, so we'll move on to the potentially kind of harder question for OPEC to solve in OPEC Plus, given how much of it is kind of outside of their hands, and looking at the petroleum demand. Now, we'll start off with a slide that it's kind of probably one of the more morbid of the day. Certainly, if like myself, you're sat in the Western Hemisphere, and that's looking at work that the FT does in pulling together the various global COVID-related cases and deaths. They do some very good work in terms of how you visualize that. Now, this one chart really does encapsulate the difficulty in calling demand into the first half of 2020, given that you see the situation in the Eastern Hemisphere with Japan, Australia, and South Korea, who have managed to get on top of COVID significantly better than we have in the Western Hemisphere. And you look at the charts there, you can't quite see, unfortunately, the dark blue line is the European Union, and then you have the United States and the United Kingdom, where the death per capita due to COVID is just kind of an order of magnitude different, essentially, to what you see in the East. Now, we're kind of heading into a Northern Hemisphere winter, and from a demand point of view, and we'll kind of touch on this later, the countries that you see there, kind of United States, the European Union, and the United Kingdom, are all introducing or continuing fairly strict restrictions of freedoms of movement, basically, with in the United States as well, many large states either having mandated stay-at-home orders or even just advised, and that's in kind of very large population centers in the US. So this really sets the tone for the problem that we have. Looking at it from a refining demand point of view, and again, focusing on the kind of the east of Suez versus west of Suez situation, the chart here looks at the slow growing trend in the east of Suez share of refining capacity. That's the dark blue line that you see at the bottom. Now that's grown by about 2% over the course of the last 5 years, just capping out at just over kind of 45.5% by the end of this year. Now, that has really been driven by a very steady addition of refining or primary distillation capacity in the east, which has continued, as I say, as a very steady pace from the start of 2016 right through to kind of the early stages of this year, in fact. And what we've seen in the second half of the year is that's basically plateaued. But that share of capacity, of total capacity, has still kept on growing because what we've seen in the Western Hemisphere, kind of west of Suez refining sector, is this steady accumulation of refineries having to permanently close capacity. So you've actually seen that share continue to tick up through the course of this year. Now, what's interesting is, as well as the share of refinery capacity, what's possibly been slightly more interesting is the share of east of Suez refinery runs, basically, of the global total. Now, they have been growing at a faster rate to the actual capacity, and that took a very kind of marked turn through the last kind of 6 to 9 months of this year, when the new efficient refineries in Asia, kind of across Asia and the Middle East, were much better able to capitalize in their position by supplying product to the market compared to, say, their older, less efficient European counterparts, who have really struggled in the demand shock. Just looking at the utilization of nameplate capacity comparisons. So in 2019, we saw an average of 82% east of Suez against 75% west of Suez. That's kind of already giving you an indication as kind of the levels of efficiencies that you're seeing in the refineries in the east versus the west. But then if we look at the second half of this year on average, that's dropped down to 74% in the east, just over 74% in the east, and 67% in the west, which is it's really at that point where you're deciding, am I going to be closing a refinery or running it, as you start to hit that kind of 60% level. So there's been some real pressure there. And moving on, we can see kind of from a clean product point of view, where we're getting this pressure from. So this chart shows the clean petroleum product oil on water, which is the dark blue line, and also the floating storage, which is the light blue line. Now, floating storage is essentially like a subset of oil on water. So what happened in Q2 was this kind of very significant decrease in demand. It's kind of well versed, well publicized, and that led to the rapid onshore building of product inventories, and then the pushing offshore of those inventories. That was seen first in oil on water. This metric includes just basically anything that's loaded. It could be slow steaming, which is still going to impact the total volume on water. It may have been moving from Europe to Asia, where it subsequently went into floating storage. So it's a more immediate way to look at builds and draws in an oversupply in the market. Now that materialized into the slightly later date into the big increase in slightly more longer term floating storage that you see in the light blue line. Sorry. Now, floating storage reached record highs in the second quarter of this year, peaking at 95 million barrels, basically. Now, we've subsequently drawn that down. So we've taken that down to about 40 million barrels. That's still twice the long-running average that we see. There's still a lot of product out there. There's still a lot of jet, still a lot of distillates and gasoline, essentially. Now, they are going to kind of continue to weigh on the product market. I think what is concerning, and this is what we think one of these kind of early indicators that we should be looking at in terms of what's the demand situation looking like, and reverting back to the slide around the fact that we're going to have increasing lockdown measures in the Western Hemisphere, is the fact that clean product oil and water has started to build in the last few weeks, and it's holding there as well. So there's kind of a real concern as we swing back into a net export environment on the clean products, that we could quite quickly be pushing product back offshore. Now, the issue that we have at the moment is that onshore storage for products is very high. If you look at the most kind of visible data available for the US, like the weekly EIA data, we have seasonally high kind of levels of storage for both gasoline and distillates, and they're building rapidly. And so there isn't anywhere near as much ability to store that product onshore, basically, now. So if we move onto kind of some of the brighter spots that we're seeing in demand, returns to demand over the course of the last few months. First off, we'll have a look at US clean product exports. Now, in this chart, the top section looks at the absolute level of US exports broken down by product, and the bottom section looks at the year-on-year changes in those exports broken down by destination. So you can see the kind of the staggering drop in Q2 exports as the global demand, that was kind of the biggest hit in global demand, was really felt then, given all of the lockdown measures. Now, if we kind of break that down by product in terms of US exports, we saw diesel exports down 35% year on year. But unsurprisingly, the biggest drop was seen in jet, which dropped by 53% year on year. And again, that's kind of going back to the comments around the floating storage. We're still seeing that jet sitting around on vessels, kind of even now, basically. So one of the bright spots, though, was actually Naphtha, where flows to Asia managed to stay elevated, and we'll touch on that in the next slide in terms of the petrochemical feedstock demand. But basically, what was driving specifically the decrease in exports from the US? Well, it was a real drop in demand from Latin America. So Brazil and Mexico were impacted very badly in 2Q. However, as we move further forwards, it's within these economies that we've actually seen a good return as well. So we have kind of rebounded in terms of US exports from the lows of Q2. They're holding fairly stable now, above the kind of around the 2.1 million barrels a day level. And if we look at the changes to where that's going, we can see that the year-on-year declines that we saw to the Americas have really been easing off over the course of the last few months, as say the Brazilian and the Mexican economies are kind of starting to get back up again. Now, that's also at the same time that we've seen a very strong recovery in the Brazilian refining sector as well. So not only the flows kind of return from the US, but the domestic production is also stronger as well. So if we move on to some of the petrochemical side of things, which, and we've touched on this in quite a few of our sessions before, about how it's been one of the real bright spots for the global demand through the course of this year. The chart here shows the cumulative imports of LPG and Naphtha into East Asia. So here we're looking at Japan, China, South Korea, and Taiwan, some of the kind of the key petrochemical demand markets in the region. And you can see that through the kind of the first few months of 2020, we were tracking roughly on a par with 2018. So 2019 was a fairly weak year for feedstock imports into the region, but we were tracking through against 2018 pretty well. And in April, or kind of in May and June, that's where we saw this real rapid increase in terms of LPG and naphtha flows into the region. That corresponds with this huge ramp up in PPE supply. The region and China in particular ramped up massively to supply PPE to the rest of the world. It also corresponds with slightly lower refinery runs within the region as well. So the domestic supply of petrochemical feedstocks, namely naphtha, were lower at the time as well. Now, it's interesting to note that since that period of kind of big year-on-year increases, which is what you see in the lower chart, that's 2020 imports compared to 2019 split by product. Aside from that really big increase that we saw back in May and June, it's actually been a fairly muted year for the rest of the year, with us basically kind of holding flat to slightly lower imports year on year. Now, as I say, earlier on, we did have a decrease in refinery utilization in the region at the time, so there's less domestic naphtha available, but that has now improved. So refinery runs have increased, and that feedstock is much more available. And we actually saw quite low imports in South Korea, just 1.1 million tons, which is the lowest in 4 years, back in October. So, having looked at kind of one of the bright spots of demand for the global economy, ultimately we want to try and say, okay, well, what else should OPEC Plus be looking at when it comes to light at the end of the tunnel for the oil sector, at least. So we'll move on and look at European refinery imports. So the European refining sector, or European crude imports, so the European refining sector is very much the bellwether for the global refining system as a whole. It has a higher percentage of kind of older, less efficient refineries than the rest of the world, particularly pointing back to the chart looking at the east of Suez capacities, particularly so compared to, say, Asia, where you have newer, more efficient, more flexible refining center. Now, the chart here looks at the total flows to Europe. So we're looking at world heading to Europe. So a bit of a leading indicator here again in terms of what the situation is like in Europe. That's the orange line. And then we look at the year-on-year difference basis destination, namely the kind of Northwest Europe versus Mediterranean region. So by June, we had dropped, the flows pointing to Europe had dropped by 2.9 million barrels a day year on year to just 8.5 million barrels a day. And that compares to 10.8 million barrels a day just in the quarter prior. So the decrease in European crude imports was dramatic, basically. Now we have, as per the kind of the US product exports, we have seen a rebound in more recent months. I think what it's interesting to highlight here is how, by and large, Northwest Europe has seen kind of sustained decreases right through to September, whereas October was kind of was a good month in terms of flows heading to Northwest Europe, but November has since seen declines again. So Northwest Europe, it's still not a great picture in terms of crude heading into that market, but the Mediterranean has tended to see stronger return. Now, looking at the country by country disparities, Italy has remained kind of 400 to 500,000 barrels a day lower in terms of crude heading there, whereas flows to Spain, Portugal, and Turkey have improved quite well through the course of the last couple of months, particularly. Just to finish off on here, and to reiterate something I kind of touched on earlier, how yes, in order for the European refining system to be able to return to kind of normal rates, we really need to see the overhang of refined products being cleared. And that's both onshore and offshore, basically. As I say, some of the most visible data that we have available in terms of, or prompt data we have in terms of inventories on the product side, you have to look at the US, and it really isn't a great situation there at all. So if we look to tie this in all together with the inventories piece and what's that looking like around the world, just a couple of slides to touch on here. The first one, little bit to unpack. Basically, in this graphic, what you're seeing is the size of the bubble is the total capacity within the region, and then the color relates to the available capacity, basically, and it's all in million barrels. The chart at the bottom is showing you the onshore crude inventories in the dark blue set against the crude oil on water in the light blue as well. So it's unsurprising that the spare capacity still remains centered largely in North America, by which we mean here the US primarily, and China, given that they have the largest inventory systems between them. Now, if we look at, say, China, which has the highest remaining capacity in the non-SPR sector, so in the purely commercial sector, at 260 million barrels a day, it's not distributed evenly. So there are 59 installations which still have capacity remaining. However, in those 59 installations, 10 of them hold 50% of the remaining capacity. So yes, you could see potentially, if you're kind of essentially going to the very top of tank tops or working capacity, like another 100 million barrels go into these 10 installations. The rest is it's going to be very hard to fill from a logistics point of view. We've touched on this before. In all these other installations, you're seeing like 1 million barrels here, 500,000 barrels there. They're going to be hard to fill, basically. It's interesting to note as well that actually, and we'll demonstrate this in the next slide, that the rest of Asia has actually increased slightly its remaining available capacity on the basis that in the last couple of months they've actually been drawing as the refining sector has returned somewhat, and the demand is there, kind of as we've alluded to in previous slides. So looking kind of finally here at the global oil on water, we can see that that's drawn down from a kind of peak level back in May at the real kind of height of the crude supply crisis, back down to just under 1.1 billion barrels a day. And that's actually below the kind of the pre-COVID levels that we saw through 2019 and into the early part of this year. Now, as you can see, though, onshore storage still remains significantly elevated. That's up 275 million barrels compared to the end of December last year, and just under 3.7 billion barrels, in absolute terms. So last slide that we'll look at from the inventories is just saying, okay, well, how has that stock progression changed across the world, basically? So the chart here looks at the 2020 month-on-month changes in onshore crude inventories at the top, and then it looks at the kind of the absolute levels in the blue lines at the bottom, and that gives you a kind of a taster in terms of what the total inventories held and how that distribution is, with the America and Asia with with the bulk, and then this long tail of much kind of smaller inventories across the rest of the world. So Chinese inventories built in all but 2 months of this year. And in fact, the only significant draw that we saw was in November, where they drew 18 million barrels a day. As I mentioned in the previous slide, across the rest of Asia, stocks have drawn 22 million barrels since their last build of 19 million barrels back in August. But despite this, there's stocks in the region are still up 50 million barrels compared to the start of the year. Now, after the huge build in the US, we saw a good few months of draws. However, we're starting to see that turn. It was reported in the stats on Wednesday with a fairly sizable build. Okay, you can say there's an element of Thanksgiving reporting that it's accounting for, but certainly even if you take it over the average of the prior 2 weeks, it's still a big build. I think the concern that it's worth highlighting here is that if we do end up in a situation of oversupply again, if we do see a return to production by OPEC Plus before there really is demand to meet it, then we are in a very different situation than we were towards the start of the year. Crude prices that we have today are not going to incentivize Chinese buying as we saw at the start of the year. And outside of that kind of demand growth in Asia, there's going to be kind of some real pressure felt if we do kind of push that market back into oversupply. So just final slide, just running through a quick summary of the situation before we head into any questions. Ultimately, non-OPEC producers were expecting to see significant growth this year, and that just has obviously, for obvious reasons, hasn't happened. However, where crude prices are today, it's looking better into next year. OPEC Plus has done well to limit supply and to bolster prices, but kind of any further developments from Libya, Iran, and Venezuela into next year are going to have to be absorbed by the group as a whole as well, and that's something that they're going to have to very actively manage. As we've touched on in a couple of occasions, that regional divide between the essentially Eastern Hemisphere and Western Hemisphere is huge on the demand side of things. And whilst there are some positive signs for the demand side of the equation, they are still focused in specific regions or sectors of the economy, and they're far from global. Now, we've cleaned up a lot of the offshore overhang of products, but ultimately the onshore inventories are still very high. And that room to build crude from where we are here is considerably less than we had at the start of the year, and the economics that will be needed to put barrels into onshore storage, I think will be actually greater than needed to incentivize earlier in the year, because ultimately the costs are going to be higher in terms of the situation within the storage system now, basically. So we'll just round off with a few questions. Should have time for 3 questions or so, and I'll start off bringing in my colleague Alex, who's going to answer a question about how do you see US shale production in 2021?
Yeah, hello. So actually, what we have to keep in mind on the US shale production is that we don't only need WTI prices to reach $50 a barrel, but we need a WTI to stay for a couple of weeks or even months above $50 a barrel WTI. So having said that, we see an average production for next year quite stable. Also because, as a reminder, the first quarter of this year has been very strong. So just coming back to the average production for the full year is already a challenge. But if we look more on the December to December production on the shale oil, we could have an increase of more than 500,000 barrels per day. And of course, it's mainly driven by the Midland, where there is a lot of pipeline capacity right now. While as Humayun mentioned, North Dakotas are much more issue right now, also as a result of Biden election.
Excellent, thanks, Alex. So I'll bring Humayun back, and we've had a couple of questions there. So first off, do you see that the OPEC production cuts and and compliance by OPEC Plus just plays in favor of shale producers?
I think it's a very good point, and I would totally agree with the question. I would say it's more a comment than a question, actually. And the fact is, if we just look at the share of OPEC Plus versus the share of U.S. shale, but also if we include other countries, like if we include the likes of Brazil, Guyana, Norway in this part, basically the share of this group of countries has been increasing massively. So we're talking about 14-15% now of global seaborne oil trade. If we look back to into 2015, that was actually down to 2%. So from 2% up to 14-15% right now. If we look at OPEC Plus, that share has been decreased from 67% to 62%, and that's not even including exempt countries, which obviously have borne the brunt of the market share losses in the past few years. I think when it comes to OPEC Plus, it's a dilemma, right? Because if the prices are too low, then their own budgets suffer, so they need prices to be high enough. If prices are high enough, then it really supports more investment into other places, especially in U.S. shale, where investment could go ahead very quickly. So I think for OPEC Plus, the mantra for 2021 is going to be to keep prices at current levels, or even maybe slightly a little bit lower, because this would prevent a lot of investment to go back in the U.S. shale sector.
Thanks, Humayun. So actually, I think there's another one that follows on from that. What is the incentive for Venezuela to export if 40% of exports goes to the USA and there are sanctions?
When it comes to the U.S. share in terms of Venezuelan exports, obviously since January 2019, we haven't seen any export from Venezuela to the U.S. In previous years, the share was mostly around a third, so let's say between 30% and 35% on average in the past few years. Obviously this would depend on what will be Joe Biden's position on Venezuela. It's likely that Biden will keep a tough position on Venezuela because he has a kind of disdain for Maduro and the human rights situation in the country. But it's also likely that he could ease sanctions slightly, with the end goal, for example, of allowing humanitarian aid to be delivered more easily in the country. There's also an economic point of view in the fact that U.S. Gulf Coast refiners could really benefit from being able to import Venezuelan crude again, given the distance and given their design to process heavier crude. So there are a few positives in which we could look like and which make sense for Joe Biden to lift or at least to ease sanctions a little bit. But it's true that the main market, the main Venezuelan markets right now, obviously the U.S. isn't part of it, and Venezuela is really looking at China and India for its oil. And also, in terms of heavy oil demand in Asia, it's been ramping up very, very fast in India and China. So the fact that Venezuela offers very heavy oil is something that not all producers can offer customers.
Excellent. And I think the last question, sorry to you again, Armin, you're bearing the brunt today, I'm afraid. How sustainable do you think Libyan production above 1 million barrels a day will last into 2021? So I think you touched on the fact you saw some potentially technical limitations that would hamper further growth from Libya earlier.
Yeah, absolutely. So, I mean, this is a very difficult question to answer because obviously we're not on the ground on Libya, and it's very difficult to understand what happens at every field. But the fact that they've been ramping production up that fast, I think it could also be explained by, sometimes when you shut down a reservoir for a few weeks or a few months, you can actually have a pressure buildup in the reservoir, and you can have higher production when you open up the taps, basically, at the beginning. So it could be one reason why Libya has managed to come back so quickly. And that could also be a reason why in the longer run, so when I say longer run, it's just a question of months, more than 6 months, it could be more difficult for the NOC, so National Company of Libya, to maintain current levels of production, as it would need more and more investment in order to sustain enough pressure in the reservoir and basically to sustain output at current levels. So I think this is the main reason why it could be technically complicated for Libya to sustain that level. But at the same time, when you look at other NOCs in the region, especially the likes of NIOC in Iran, back in 2016, they managed to keep that production high for a long time. So technically, they're also quite technically capable companies. So the fact that they managed to keep production high is also possible.
Excellent. Thank you, Armin. Well, I think that's all the time that we have. Thank you for joining us for our webinar today, and we will see you in the new year.